the first part of my career, the international investors I advised on China couldn't really tap into the domestic A-share market. So the discussions I had were always about how China was impacting world markets and what were the best China-related global investment plays. But from 2009 onwards, I started to advise Chinese domestic fund managers, and my focus broadened as I sought to help them navigate China's economic and market developments. It was a totally different ballgame. Here I want to stress that now China has thrown the doors of its huge A-share market open. Foreign investors can no longer ignore it. But first, they must understand how it works. China's domestic equity market is huge, especially for an emerging economy. No market of this size has been so restricted to foreign capital. A-shares in China are listed on two exchanges, the Shanghai and Shenzhen. Shanghai has historically been home to large SOEs, and Shenzhen has focused more on small and medium-sized companies and increasingly on IT and new economy names. The Chinext board in Shenzhen caters specifically to such companies. Listings in China have had two distinct features: the need for regulatory approval and an immediate jump in the price once trading begins. The China Securities Regulatory Commission directly approves all A-share listings. Talk of moving to a disclosure-based regime has gone nowhere for a decade. When the secondary market has come under pressure, the CSRC has periodically suspended IPOs to ease the strain, and conversely, at times of market strength, there can be multiple listings in one day. To try and ensure that investors are not misled by flashy sales pitches, IPOs have been priced at a common PE ratio of 23. Yet the market trades at a much higher ratio, with smaller names attracting richer valuations. In China, new issues are massively oversubscribed and typically jump during the first week of trading. Concerns though persist that listed companies treat the share market as something of a piggy bank. Judging actually by the huge volume of secondary offerings, that worry isn't groundless. China may not have developed a fully mature market, but actually it's important to know that the nuts and bolts of trading and settlement are extremely efficient. All trading is electronic and every investor must pre-fund their account. In other words, they must have enough cash on hand to settle the proposed transaction before they trade. Pre-funding has long been part of the Chinese market and isn't surprising given the country's credit history. China is often portrayed as a market of retail investors. They're still there, of course, but the deep-seated idea that the country is dominated by mom and pop traders no longer tells the true story. Although individual accounts make up more than 99% of the total, that simply means they were opened in the name of an individual. Many Chinese investors borrow accounts and use multiple accounts to hide their trading. The clearinghouse in China used to publish figures showing how much was held in each account, and while small sums did indeed predominate, the bulk of individuals' holdings was concentrated in very large accounts. So instead of mom and pop, think high net worth. Many corporations are active in the stock market in China as well, and the domestic fund management industry has grown significantly in the past 20 years. in front of my eyes in the past 10 years, but its role is still limited. And as in all areas of the Chinese economy, leverage and borrowed money now play a significant part in the stock market. Margin financing peaked with the 2015 bubble. It has been drastically cut back since then, but remains an important element. A second, even larger source of leverage is pledged shares. This is the practice of large, often controlling shareholders pledging their shares in listed companies to a brokerage in exchange for cash. And since the earliest days, China has understood the importance of attracting foreign capital and nurturing developed market discipline, but it has only just now fully embraced foreign intermediaries and investors. Despite its huge size and excellent infrastructure, the market is still disparaged, both locally and internationally, as a casino. And unfortunately, there's truth to the charge that it's a market blighted by poor disclosure and rampant insider trading. What's more, the Communist Party doesn't fully trust market forces. It craves control and doesn't hesitate to meddle if potentially destabilizing boom or bust is shaping up. It did just that in 2015 when it suspended trading and then enlisted its national team to prop up prices. So, to find out how foreign investors can access the Chinese equity market, whether they are likely to play a larger role and how that might change the rules of the game, tune into the next video.